Picture this. There is a company that's been hanging out dividends every single year since 1969. That's older than email, that's older than Apple, that's even older than moon landing broadcast in color. And yet, almost unbelievably, that stock has been chopped by almost 60% in the last 2 years, and it pays today almost 5% of dividend yield. And no, I'm not talking about some obscure industrial name. I'm talking about Target. Yep, that's the one when you go in for a toothpaste and somehow leave with a cart full of seasonal decor and a receipt of $200 at least. So what's going on here? Is this a chance to buy the dip, or is this the dip going to keep dipping? Let's dig in. Let's zoom in on the basics. Where is the Target standing right now? Ticker TGT. Current price $94. Dividend yield almost 5%, to be precise 4.77%. Insane. P ratio 10, much lower than the 5-year average of 18 or almost 19. Annual dividend is for almost 4.5 per share. Market cap is $43 billion. So it's cheap by historical standards and cheap compared to competitors. But cheap isn't always a bargain. Sometimes it means problems. The key is figuring out which one we are looking at. Let's talk damage. Back in late 2021, Target was trading around $260 a share. Today, it's only $94. That's a nearly 64% drop, which is massive for a dividend aristocrat like this. Not just a dip, a full-blown markdown. Now, let's rewind to the Great Recession. In 2008, Target fell from $65 down to $28. That's a 57% decline. Brutal at the time, but it made a 250% recovery over the next few years. So now we ask, is this the 2008 playbook repeating itself? Or is this a different kind of story? One where the recovery may take longer or never come at all. And here's something dividend investors should really pay attention to. When it comes to dividend stocks, timing matters. Right now, you're getting nearly the same dividend Target was paying at $260, except you are paying almost half the price. That means your yield on cost is through the roof. And if the stock even recovers, you are not just holding a steady income machine, you've also got a sneaky capital appreciation play on your hands. That's the kind of double win we are always hunting for. Now, if you are new here, I only make videos about time-tested, dividend-paying giants, companies with bulletproof histories of increasing dividends year after year, and the high probability of doing so for the rest of your life. No short squeezes, no meme stocks, no hype, just reliable income. What's going on financially? Let's break down the income statement and balance sheet. Financial year 2024 revenue is $106 billion, slightly down from 107 in financial year 2023. Financial year 2020 revenue was $93 billion and grew 14% from 2020 to 2024. EPS history in 2020, you see that's around $8, and 2021 it's much higher, it's 13.5 COVID retail boom year. 2022 back down to $8, 2023 8.9, 2024 $9. So while EPS has cooled off since the 2021 spike, it's stabilizing and still comfortably covers the dividend. Free cash flow is positive, but trending flat. Current ratio is 0.83. That tight liquidity. Debt to equity ratio is 1.27, higher than we'd like it to. No, Target isn't in crisis, but they are navigating through some rough current shrinking sales, pressure on margins, and rising operational costs. Still, they are profitable and, importantly, still paying that dividend. Quick timeout. If you appreciate this kind of no-fluff data-first breakdown, hit that like button. It tells YouTube that you are this kind of serious dividend content. Let's talk dividends. This is where Target still flexes, and why long-term investors still stick around. Let's start with the basics. Current dividend yield 4.77%, almost double the average yield of the S&P 500 right now. Dividend growth streak is 54 consecutive years. That's not just dividend king status, that's Hall of Fame stuff. Payout ratio, and here is not bad, 49%, meaning they are only using about half of their earnings to pay that dividend. That leaves plenty of buffer if earnings take a hit. Now, let's zoom out a bit. If you bought Target 10 years ago in 2015, your cost basis on the dividend would have been around 3%. Today, you'd be earning over 8% yield on cost without lifting a finger. That's the magic of reliable dividend growth. What's more impressive, even during rough stretches, 2008 crash, COVID disruptions, the current retail shakeup, Target never once got that dividend. They keep raising it. That kind of a commitment is rare. And it's not just about the checks you get every quarter, it's about the confidence. It's about knowing this company is run in a way that puts long-term shareholders first. So yes, the stock price may be beat up, but the dividend, that's still a fortress. Now let's see where Target is comparing to big dogs. Let's stack TGT up next to Walmart, Costco, and Amazon. P ratio for Target is 10. Walmart, on the other side, is 42, Costco 60, and Amazon 33. Dividend yield, well, you see Target is clearly winner here, 4.7, Walmart 1.4, Costco 0.6, and Amazon doesn't pay dividends at all. You can compare debt to equity ratio and current ratio just for information here. It's not ideal, it depends really on but for all of those competitors, that's not ideal. Well, Costco is probably one of a big exception. And market cap, look, Target is 43 billion, whether Walmart is almost $800 billion, and Costco is 460. Well, Amazon, of course, is leader here. Is market cap through the roof, $2 trillion. So what's the takeaway? Target is the smallest fish in this pond, but it's dishing out the biggest income stream by far. Walmart and Costco are operational beasts, but they're not income machines. If you want stability and scale, they win. If you want yield and value, Target's in the lead. Amazon? Well, it's a tech monster, but no dividend at all. Target's P is dramatically lower, which may mean undervaluation, or it may reflect real risks. That's for you to weigh. Another big point, debt. Target's higher leverage compared to its peers adds risk. That said, they've been able to manage it while maintaining their dividend streak. So if you're hunting for an income and long-term recovery potential, Target must just be your guy. But if you are more conservative or focused on capital preservation, you might lean more towards Walmart or Costco. What's Target actually doing? Target isn't sleeping on its problems. They launched an enterprise acceleration office. Sounds fancy, but that's basically its full-on overhaul strategy. They rolled out AI-powered store companion tools chain-wide, digital training and support bots for employees. New CFO Jim Lee from PepsiCo. By the way, we just did a recent video on PepsiCo. You can check it here. That's another great dividend king that worth to consider buying probably at this point. They're remodeling stores and investing in their strongest asset, private label brands. Execution will be everything, but the blueprint looks promising. What are the risky bits? Well, here's what's dragging the stock. DEI backslash led to a 40-day boycott and a $12 billion market loss. Tariffs are raising costs across the board. Q1 2025 earnings missed badly, 1.3 EPS versus expected 1.6 EPS. This isn't just a market tantrum. Some of this pain is self-inflicted, and Wall Street noticed. Where should you buy? It's up to you to take your own decisions when to invest or not. Here's my personal breakdown on where I'd consider buying or trimming. Well, strong buy under 88 for sure. You're locking in great value and yield. Buy zone 88 to 95, still attractive for long-term holders. Well, above this, hold, probably hold forever. So what's the verdict? Target is bruised, but not broken. The yield is high, the payout is safe, the valuation is low. You're not getting explosive growth here, but you're getting a reliable inflation-beaten stream of cash flow. And that's exactly what long-term dividend investing is about. If it dips under $90 again, I'll be seriously thinking about adding more. Not a financial advice. I am not your financial advisor. Do your own research and make smart investment decisions on your own. If this video gave you clarity, give it a like, subscribe if you want more breakdowns like this, and drop your take. Would you buy Target under $90? Or you're avoiding retails altogether? Thanks for watching and see you in the next one.